Welcome back, gang. Before we begin, let's do a quick recap from our lesson 2. So if you guys remember from yesterday, we talked about bringing structure to chaos, the chaos that we call the market. We talked about how having strict ROEs, remember the rules of engagement, that use an if-then thought process is critical for successful trading. We discussed the expectancy formula and how if you have a negative expectancy, then you just have a losing system and you need to stop trading. We discussed how you can build your own system using 100% objective ROEs. And then finally, gang, we discussed what gives the PPT system an edge. So let's get started on lesson 3. Gang, today truly is what I consider to be the holy grail of trading. And it all begins with what we call 6 inches of risk. So here's what we're going to learn. 6 inches of risk. Gang, this is all about the 6 inches between your ears. That's where trading success begins. You see, trading success is a mindset. Too many traders focus on what they can't control. Gang, you can't control the markets. Stop trying. Look, if you're a trend trader and the market's going sideways, there's nothing you can do about it. You can control 3 things. 1, where you enter. 2, where you exit. And 3, how much risk you put in each trade. Gang, I'm going to give you a gift. Now, this gift cost me $1,200. We talked about it some yesterday. I'm going to share this gift with you and tell you how it transformed my trading life. And then finally, gang, risk management made all the difference in my trading success. So let's get started with 6 inches of risk. Are you guys all aware that 90% of traders fail? Why is it so high? So let's break this down, gang. Listen closely. The market has no boundaries. And what I mean by that is there's no rules. If you want to buy, you can buy anywhere you want on a chart. If you want to sell, you can sell anywhere you want on a chart. Guys, that's why I blew through 2 accounts. And I'm sure some of you have done the same. And we talked about my story a bit, but gang, my ego got in my way. I was broken. And I finally realized that I didn't deserve to trade real money, so I stopped. And I'm pleading with you today that if you're trading with real money and you don't have rules, just stop trading. Remember, the definition of insanity is doing the same thing over and over, yet expecting different results. So I want to tell you guys a quick story. So after losing money on many different systems, I was talking with my mentor, the guy who taught me how to trade options. And he asked me a question. He said, "Hey, Mark, what was one constant in all the courses that you paid for?" I kind of looked at him with, I'm sure, with this dumbfounded look. I said, none of them worked? He said, "No, Mark. I'm sure some of them did work. The one constant was you." I was like, wow. I didn't want to hear that. I mean, that's kind of harsh, right? So guys, recognizing that I was broken, what I did was I hired a trading psychologist to see if he could fix me. I couldn't fix myself. One thing he taught me was that most beginning traders have rigid expectations. Now, I'm going to get more into that in a minute. But first, I want to tell you the very first thing he told me. Gang, it was 2 words. Trading sucks. Well, he definitely got my attention. Look, I'm paying this dude, and all he's doing is confirming what I already thought, what I was feeling. But bear with me here for a second, gang. Think about what he's actually saying. The problem with trading is you never allow yourself to feel good. You're either upset about a losing trade because you lost money and it kind of stings your ego, or you exit a winning trade only to see price continue to rip higher and you feel like you left money on the table. Either way, you're just not satisfied. Okay, think about it. Remember the last time you were short, you took profit at $100, and all of a sudden you look at the chart later, you could have made another $500. You thought, why didn't I trail that one? Well, how can this be fixed? So here's my gift to you, gang. And yes, everyone asked yesterday, but these meetings cost me $1,200. He wasn't just any psychologist. He traveled the world working with institutional traders. So after many long hours on the couch, I came in with 4 primary takeaways. Let's take a look. Number 1, most traders are rigid in their expectations, but they're flexible with their rules. Gang, markets change. They go from trending to sideways. Would trend traders expect to make as much in a sideways market as in a trending one? I hope you're saying no. Gang, I've talked to traders every week who get frustrated with the sideways market. Like, I can do something about it. Diversification is key here. A lesson I learned the hard way. Number 2, rigid rules for entry and trade management are necessary. You must know, and here's the key, gang, you must know and accept your risk to remove the emotions associated with each trade. Number 3, you need an objective set of rules that are repeatable and can be tested. After all, how can you test a system if you're constantly doing something different? And then finally, gang, number 4, focus on the process over the profits. So here's what I found in my own personal trading. When I honored these 4 things, my win rate started to remain constant. I learned that trading with a high time frame trend actually helped my win rate improve. I also learned that if I waited for price to enter my predetermined LCP zones, my win rate improved. In addition, using price patterns increased my win rate. Gang, this is when I found my edge. And it all began with risk. So I want to ask you all some questions. They're rhetorical. I just want you to think about them. Have you ever taken a bigger loss than you expected? Have you ever taken profit early on a trade? Have you ever missed out on a winning trade because you hesitated on the entry? Gang, this only happens for one of 2 reasons. Either 1, you have no trading rules, or 2, you have rules and you broke them. Let's look at 2 scenarios. Okay, so I get short. I put my stop, I don't know, wherever I want. I don't know where it should go. I just place it on the chart. Or I get short, I put my stop at 15 ticks, and I accept the outcome, which sounds like a better plan. Look, gang, I've been there. And I know from personal experience it's just not sustainable. Any person with a computer and a trading account can be a trader. But it takes a predefined plan with if-then thought processes for entry and exit to think like a trader. This removes the subjectivity and allows you to be mentally prepared to execute each trade. Gang, when you stop focusing on the profits and you start focusing on the process, you're able to remove the emotional control associated with each trade. Now, would you be surprised to know that we're not alone here, gang? There's proof of professional traders doing the exact same thing, breaking their rules. Let's take a look. I'm sure some of you have heard of long-term capital management. We're going to do a quick recap of them. So they were a large hedge fund. They were led by Nobel Prize-winning economists and renowned Wall Street traders. What a great combination, right? Let's see. Well, they nearly collapsed the global financial system due to their high-risk arbitrage trading strategies. They actually had $5 billion in assets, and their positions worth over $1 trillion. Talk about leverage. Here's what happened to them. They got bailed out by the Federal Reserve. Let me ask you something, gang. How many of you are going to get a bailout if you blow your account? There's no bailout for us. So this was back in 1998. Let's take a look at a recent example. Catalyst Hedged Futures Strategy Fund. That's a mouthful. Jeez. Okay, here's what they did. They took a large bearish bet against a bullish market. They were betting that a Trump victory would spur market selling. They lost $600 million in 4 days, which represented 15% of their fund. So it actually got me wondering. I wonder if their trading plan said something like this: if Trump wins, then short the market. Gang, these aren't stupid people. These are emotional bets. It's greed. And they did it without a plan. We all have to stop the madness. Here's what you need to take away from this. Remember in our prior lesson, we discussed 3 PPT system trades. One had a $10 loss. Initial stop loss was 15 ticks from entry. We were able to reduce the loss from 15 ticks to 1 tick, cutting the risk by over 90%. The second one had a $150 profit. And the third one, another $150 profit. So let's discuss this and talk about the PPT way. So in PPT, I use a static target of 15 ticks, a static stop of 15 ticks, and then I manage the trade very aggressively using either a 2-bar rule, which follows microstructure. I'm going to teach this here later in the lesson, or using the fib trail dots after price moves in my favor by 10 ticks. So the 2-bar rule is pure price based, and the fib trail dots are volatility based. Let's dig into the 15 by 15. So in every trade, I record 4 data points. We have the entry. Now, after my entry, the first thing that I do is I place a stop of 15 ticks. I place a target of 15 ticks. So in this particular trade, price moves against my short, and then it moves in my favor, hitting target. At this point, I know what my MAE is. The MAE stands for maximum adverse excursion. It's how far a trade goes against me before it hits target. After my target is hit, I wait to see where my trail stop would have been. In this case, here's my trail stop. Price comes up and takes me out. But remember, I was already out of the trade at the target. But I follow it because, remember, gang, I said I record 4 data points. I always record my entry, my MAE, my MFE, and either my target or my stop. This is important, gang. This allows you to learn your trading business inside and out. You'll no longer question where your stop should be or where your target should be. You'll no longer be frustrated on those trades that you exit and then price continues to move another $500 in your favor. It'll get rid of that little trading devil inside your head saying, stay short, stay short. You're going to know that you did the right thing because you know that over the past 500 trades, your way produces the most profit. Let's look at another example that does the opposite, because I want to make sure that you all understand this MAE and MFE. MAE, again, before we move forward, MAE, maximum adverse excursion. It's how far a trade goes against me before it hits target. That was this point right here. The MFE is the maximum favorable excursion. It's how far a trade goes in my favor prior to where my stop would have been hit. So here's another example. Here's my entry. Here's my stop. Here's my target. Price goes in my favor, and then it stops me out. So in this case, my MAE is going to be 15 ticks. I was not allowed to move my stop. And my MFE is down here, which is the maximum favorable excursion. Now finally, I want to show you an example where price actually doesn't hit my target or my stop. So here's the short entry, here's my initial stop loss, and here's my target. So in this example, price goes against me, then it goes in my favor, and at this point I was actually allowed to move my stop to here. Then price takes me out. So in this example, here's my MAE, and there's my MFE. So let's look at a real example. Okay, here's the LCP zone. Here's my entry price. Here's my immediate stop loss, initial stop loss, and then here's my target. So again, here's the key. I'm going to manage the trade using the fib dots after 10 ticks MFE, or I'll manage the trade using the 2-bar rule, whichever one allows me to cut risk the most. So in this example, price moves 10 ticks in my favor, so I'm going to move my stop 5 ticks above the fib dots. My new stop loss is right there. This would have been a risk-free trade. It did hit target. So now let's talk about the 4 different types of stops that we can see. One is just, it's a pure price stop. We talked about it, the 2-bar rule. Number 2, dynamic stop, using the fib trail dots. Number 3, a volatility-based stop, using the average true range. And number 4, an indicator-based stop. For example, if I'm short and price closes above the 10-period moving average, I'm going to exit the trade. So let's start by talking about the 2-bar rule. We're going to walk through this step by step. Okay, here's my short entry. Initial stop loss comes in at 15 ticks. My target's going to be 15 ticks. So here's what I'm looking for, gang. I'm looking for price to put in an up green bar. Then I want to see price close above the high of the first up green bar. Then I want to see price make a higher low. So I have 2 or more up green bars where the second one closes above the high of the first one. And price makes a lower high. And then number 4, price needs to close below the low of 0.1, which is right here. It closes below right here. At this point, I'm going to move my stop 5 ticks above this lower high. This is how I cut my risk. So in this specific trade, I was able to move my stop from 15 ticks to 9 ticks. Gang, that's a 40% reduction in risk. And then the trade went on to hit full target. So let's look at the same exact trade, but using a different stop that we call the dynamic stop. So here's the short entry. Here's my initial stop loss. For the dynamic stop, if price moves in favor by 10 ticks, so 10 MFE, then move stop 5 ticks above the fib trail dots. So here's where price moves 10 ticks MFE. So my stop would go right there. Gang, in this example, I actually cut my risk from 15 down to 1, over 90%. Gang, what I want you to take note of is just notice how structured the rules are. Constantly using the if-then thought process. You see, this takes away any decision making that I have to do in real time. See how easy this is, gang? Honestly, anyone can do this. So now let's look at the same trade, but using a volatility-based stop and target, or what we call the ATR. So here's my entry. Now, here's what I need you to notice. Right down here, gang. This neat little indicator. What this is telling me is that my ATR in this specific example is 9. My stop is going to be a 1 ATR and my target is going to be a 3. So my initial stop loss is 9 ticks. And then my target is 27. Now the nice thing about this particular type of strategy is there's no trade management. So I'm either going to hit my target or I'm going to hit my stop. Let me show you how powerful risking 1 unit to make 3 units is. So let's introduce expectancy again. So let's take, for example, a system where the average winner is $270 and it wins 40% of the time. The average loss is $90 and it loses 60% of the time. So let's fill in our formula. We take the 270 times 40, that gives us our win expectancy, minus we take 90 times 60%, that gives us our loss expectancy, and then we subtract those two, right? That gives us 54. So the expectancy over the next 100 trades is $5,400 before commissions and slippage. Okay, let's go to the final strategy that some traders may prefer. An indicator-based stop. So let's just look at an example using a 20-period moving average. Here's the short entry. Here's the initial stop loss. In this example, there's no target. If price hits 10 ticks MFE, then close the trade once price closes above the moving average. Here's the 10 ticks MFE. There's where I'd close the trade. So notice how when price breaks the structure support here, it accelerates to the downside and pulls away from the moving average. Then as price goes sideways, the moving average actually catches up. That's the value of the moving average exit. It allows you to stay in the big momentum moves while tightening closer to price when it goes sideways. So let's recap and put the finishing touches on this part of the lesson, gang. So here's what I want you to take away from this. The benefits of objective risk management allows you to quickly determine if a strategy fits your personality or your personal risk type or appetite. Sorry. So think about what I'm saying there. When you know your exit and you can test a strategy, then you get a feel for the size of the system drawdown. This allows you to trade without emotions. It allows you to determine if a strategy has a positive expectancy. Remember we talked about yesterday. If you have a negative expectancy, then you just have a losing system. It allows you to fully accept the risk in each trade. Remember, gang, when you fully accept the risk in each trade, you're going to stop missing trades that you should be in. And then finally, you're going to stop exiting profitable trades early. Look, you're either going to hit your target or you're going to hit your stop. There's no need to exit the trade before this. Your testing has shown you the benefits of being patient. Let me show you the 2 stop strategies that I employ with PPT. The 2-bar rule and the fib trail dots. And as I mentioned, I use whichever one allows me to cut my risk the most. Guys, I'm more conservative with my entries. And for me, I want to cut my risk as quick as possible while I'm in a trade. This is why, gang, this is why I can trade at below 50% accuracy and still make money. I'm making more on my winners than I'm losing on my losers. Let me show you an actual example. Okay, so here's a trade. We got 2 up green bars. We got our close below, so you can move our stop 5 ticks above this area. So that allows me to cut my initial risk. However, then the trade goes in my favor by 10 ticks, and now I can move my stop 5 ticks above the trail dots, allowing me to cut risk further. So gang, now what I want to show you is the power of proper risk management. I'm going to show you some real examples of 50 trades. But first, here's a weekly chart of the market that I've been trading. So here's a 13-week period where the entire high to low range was only $5, and less than half of that range was being put in during the day session. So as you can see, gang, there's not a lot of opportunity available. Even with these tight ranges, the system still generated a 12% return after commissions. Now that's including all aggressive and conservative signals. Gang, this type of market is where it's crucial to know your business. Do you know your business? Let's do a quick lesson here on trading psychology. Not knowing your business and your business statistics can kill your trading mind, and thus your trading business. Let me show you the power of believing in your system. So here are 25 trades, gang, that we recently had with the PPT system. Here's our summary of these trades. 7 winners, 18 losers, 28% accuracy. Performance, $620 per contract loss. So the average loser per trade was almost $25. So, got a question for you. If I told you that you were going to have a string of 25 trades where you had 7 winners and only lost $620, how many would be excited about a system that's winning 28% of its trades? Come on, gang. Hit me. Show of hands. Anybody? Anybody excited about that? Oh, we got a few. Okay. All right. So now here's another question. Be honest. How many of you could have stepped up to the plate after these 25 and taken trade 26? Tom said he may not be excited, but he's going to step up because he believes. Attaboy, Tom. Greg said he would move on to another system. Try his hand there. Man, Greg, I can't say I blame you there. Okay, gang, listen. Look, I get it. I used to feel that way too. But because I believe in the PPT system and our owners believe in the system, we stepped up, we took the next 25 trades. Let's look at what happened. 19 winners, 6 losers, 76% accuracy, $1,940 per contract. Average trade, $77. Gang, this is proof. It is all about risk management. Objective risk management. 1, the 2-bar rule. 2, the fib trail dots. So gang, great lesson today. It's killer information here. Let's just put a bow on this thing. And remember, we talked about this in the lesson yesterday and today. You can't improve on what you can't measure. So remember my $1,200 lesson that you got here for free. Number 1, most traders are rigid in their expectations, but flexible with their rules. Rigid rules for entry and trade management are necessary. You need an objective set of rules that are repeatable and can be tested. And you must focus on the process over the profits. So gang, before we end this, let's discuss what you will learn in lesson 4. So in lesson 4, we're going to talk about how you can utilize filters to increase the average profit per trade, increase your win percentage, decrease your loss per trade, and decrease your loss percentage. Gang, we're going to discuss filters. We're going to talk about how a couple of objective filters can have a massive impact on your trading performance. I'm going to show you a system, actually one that I'm testing and finishing right now. I'm going to show you the impact that 1 directional filter and 1 volatility filter had on the profit. And then finally, gang, we're going to talk about the power of position sizing and how you can get a 200% increase in profits taking the same trades. Now, gang, this was very eye-opening for me, and this is powerful. Okay, gang, I'll see you in the next lesson.